Hi, I'm Ed Alexander, founder of the Entrepreneurship Law Firm. In this video, I discuss the different types of investors, knowing which one you're dealing with and which ones you want to go after. So when it comes to investors, I find over the past 18 years of practice that there are three types of people who invest in early stage companies. These would be the investors, missionaries, and gamblers. I'll get to the investors last. Missionaries are people who invest in the company not because the company can make them money, but because of some other purpose. This would be your friends and family. They like you, they're going to give you money, and they just frankly have absolutely no clue whether this business is going to be anything. Then there are the gamblers. The gamblers will take a fly on almost anything just to see if it turns out. The higher the risk, the better for them. A lot of gamblers got wiped out in the past couple of years with the change in the economy, so there's not too many of them around anymore. And then there are the investors. Investors make a professional and reasoned decision about whether to invest in your company. So when you're looking at a prospective investor, you want to understand what they're doing to evaluate whether or not to make an investment in your business. Now, there are three types of investors that you want to take a look at. The first are what I call Rolodex investors. Now, these might also be called friends and family investors. These are typically the people you tap in the early first stages of your business. They're going to give you a few $1,000s to get off the ground. The next stage above that are angel investors. In the past, angel investors would put up to about $1 million, but usually in chunks, 2 or 3, 250,000 chunks, maybe 4 $250,000 chunks. This has changed a little bit, and angel investors are getting together and forming angel groups, and they might make investments as much as $1.5 million, all the way up to $3 million. And then finally are venture capitalists. Venture capitalists are investors. There are venture capitalists that will invest in early stage ventures, but most of them invest in ventures that are already humming along. And the typical investment for a venture capitalist is $5 million and above. Now, the reason this is because venture capitalists create funds, and they get their money from third parties like retirement funds and insurance companies, and they pool that money and then have to deploy it in companies. So they might raise $100 million or $200 million, and as they're deploying that capital, they can't deploy it in little teeny chunks because they can't actually watch over what happens. Venture capitalists take an active role in your business. They'll sit on your board, and they actually have people who will render services to your business. When they do all these things, it's very difficult for them to do this for 50 or 100 or 150 companies. So they tend to make larger investments and watch those investments very closely. Thanks for watching this video. Our next video is going to be talking about valuing your company to determine how much equity you have to sell.